why Goldman Sachs is wrong yet again with their future oil price forecasts, next on the Energy News Beat podcast.
Hey, let's start with our buddy. The Trump administration fast tracks Utah uranium mine, signals robust push for critical minerals. Michael, this is extremely critical. I'll tell you why. The Velvet Wood mine is a bellwether for the Trump administration's critical mineral strategy as the U.S. seeks to secure its supply chain and reduce the reliance on foreign adversaries. Michael, this is critical. Once operational, it's expected to deliver and process 1.9% of the uranium needed for the U.S. on a national basis. Michael, that is important. 1.9. You may sit there and go, oh, that's only 1.9%, Stu. I'm like, hell yeah, that's the first part of uranium mining processing in the U.S. This is huge. I came up with this idea to write this article today after interviewing David Blackman, Robert Bryce, and Doug Sandridge on a live podcast that'll be coming out on our Energy Newsbeat Substack channel on Friday. And it was very important. Those are three other great minds, not mine, theirs, and they came up with a great point, and that is uranium mining is critical.
It really is. And this is all part of the broader critical minerals agenda, Stu. And there was 3 or 4 things that were kind of listed as key initiatives. The first one being executive orders for nuclear and mineral development. The next one being permitting reform for critical minerals. The next, this one's spicy, deep sea mining exploration. Wonder if it's the same Ukrainian SEALs that got Nord Stream. They've got experience underwater. And finally, different trade and tariff measures, specifically to address vulnerabilities in the critical minerals supply chain. That's going to be headed up by Commerce Secretary Howard Lutnick. But I think the implications of this, as you talked about in the article, are, pun intended, critical, because we need these critical minerals if we are going to eventually start insourcing. And if we really do want to go all solar, as Elon says, which we can argue with, right, left, up, down, whether or not that's a good idea. But even if we want to even have that conversation, we better know that we can be able to actually build these items in-house.
And I'll tell you what, I learned an awful lot from Robert David Blackman and Doug Sandridge today about nuclear and where we're going as it ties into this. So our readers are on the Substack going to really enjoy that one as it comes out on Friday. But Secretary Burgum is doing a fantastic job running down the road with Secretary Chris Wright on this critical issue. But Michael, the number one problem that we have for mining in the United States is regulatory holdup. Oops. And so you take a look at regulatory holdup for building nuclear, it's the same thing. But now that President Trump's executive order allows this to be done on federal lands with a bypass to regulatory problems. Oops. That is what I'm going to be watching for.
Absolutely. All right, what's next?
Let's go to the second FSRU arrives in Egypt. Why did an LNG export country now have to start importing energy? Michael, I'm going to ask you a question. Without knowing anything about this story, do you think it was because of green energy policies and climate change, or do you think it was just bad management?
I'm going to say bad management. Egypt doesn't strike me as somebody who is interested in solar.
And guess what? It is climate management. They are all in on the UN climate gig, and I didn't see that one coming. Energy's Egypt is heavily reliant on fossil fuels, particularly natural gas. And now Egypt is energy landscaping, accounting for 79 to 84% of their electricity generation in 2023. But now they're having to import it, and they added another import facility for LNG because they are not producing enough. Energy security starts at home. This is pretty important.
No, it really isn't. And I find it fascinating, really, that Egypt has dove in headfirst into climate change. They, with a robust amount of energy, specifically fossil fuels in their country, it's really surprising that they've done with. And I think it goes to show how, as you said, the policy impacts that the IEA and all of these global entities do, how much it rubs up on these countries, and how it really should impact from a capital allocation standpoint where people see investment opportunities.
Oh, absolutely. And what I find very fascinating is as I'm writing all these stories and looking at how tankers are being reused as a regasification unit, I did not know that regasification units were actually tankers that have been obsoleted and then replumbed to be a regasification unit. You pull it up onto shore, you've got you an import facility by redoing a tanker. That's pretty darn cool. But how it's doing it, who's doing it, and why is why I wrote the intro to that article.
Absolutely. All right, what's next?
Let's go to our buddies over there at Cheniere. I absolutely love Cheniere. Cheniere is a great, well-run company, and good leadership means good numbers, and Cheniere gets the okay to introduce fuel gas to the second Corpus Christi expansion train. This is absolutely huge. The FERC granted Corpus Christi liquefaction May 6 request to introduce fuel gas to the mid-scale train 2 for the stage 3. This is important. So I added on the top of that article came in from, I believe it was LNG Prime off of our feed, but I added all the other information on the Sabine Pass, Corpus Christi terminal, and combined current capacity. And it looks like it's 45 MTPA of LNG out of that facility. It's pretty important. That is a lot of trading bucks for President Trump, offsetting some of his trade balance.
Well, absolutely. And if we're going to have LNG and become a LNG exporter, it's projects like this that need to be fast-tracked through the regulatory process, because there's only one way to get your LNG to market, and that's to build these type of facilities. And so it's great, like you said, to see Cheniere continuing to move forward with. I mean, the capacity is going to be crazy, and this really ties really well, Stu, into the thesis that you've been saying now for years, that LNG is the new frontier for investment. And you're seeing capital begin to pour into that. We've covered last week that the Middle Eastern countries, Saudi Arabia, Qatar, UAE, have all come in and committed huge dollar amounts into what? United States LNG infrastructure. And we talked last week, we differ a little bit on whether or not that's a good thing. I think it's a great thing from a strategy standpoint. I think now having investment from Middle Eastern countries in our energy may at some time present security problems, specifically from if this is where we're getting all of our, we want to make sure we own our infrastructure. But all in all, this is the type of stuff that we need to be doing. And as you said, great management, great numbers. We love Cheniere. We love what they're doing.
You bet. I'm off to you now.
All right. Well, let's jump over, quickly cover oil and gas finance, guys. But before we do that, let's quickly pay the bills. As always, guys, news and analysis brought to you by EnergyNewsBeat.com. You can hit that description below. All links to the timestamps, links to the articles. Highly recommend you guys checking us out, theenergynewsbeat.substack.com. We're rolling out a lot of great new features specifically for free subscribers, but also more specifically for paid subscribers. So if you're interested in supporting the show, highly recommend you check us out and give us a paid subscription there. You're going to be starting to get monthly State of the Unions, which are following up on our quarterly State of the Unions that are going out to the public. You're also going to start getting the archive of all the stories we've ran previously and specifically content that we've run there. And then finally, we're going to start rolling out some specific Energy News Beat Substack research articles, which dive into some of the minutia of the oil and gas research that we do here internally that we're going to begin sharing with paid subscribers. That's theenergynewsbeat.substack.com, link in the description. Also, thank you to Reese Energy Consulting for supporting the show. We love them over there, guys. ReeseEnergyConsulting.com. If you're in the upstream space, please call them. They'll save you $5 on your first purchaser in nat gas contracts. If you're in the midstream space and you at all have a need somewhere, whether you're trying to get a new pipeline permitted, whether you're in the process of trying to you need a red team analysis to come in and say, let's think for a second here. Should we actually be making this strategic investment? They've worked with companies from, one guy in a garage all the way up to the largest publicly traded companies in that space. So highly recommend checking them out, Reese Energy Consulting. energynewsbeat.com. And finally, guys, if you are interested in allocating capital to the energy space, invest in oil.energynewsbeat.com gives you a great resource on how to think about where to allocate capital in this time. Obviously, prices being down, you may wonder, hey, I'm thinking about putting money in the energy space. Where do I do it? That ebook does a great job of breaking down the different ways you can invest specifically in the upstream space. And then specifically, and also again, the big reason why you want to consider allocating into the energy space is you can then go to parties and say you are Billy Bob Thornton. So hit that link, investinoil.energynewsbeat.com, if you want to get that ebook. We'll get that in your inbox right away. But Stu, let's quickly go top line indices today. S&P 500, NASDAQ, both up 2.5 and 2.3 percentage points themselves. 2 and 10-year yields fall 0.4 percentage points, 1.3 percentage points. Dollar index, 0.6 of a percentage point. Bitcoin down 0.4 of a percentage point. And then crude oil sitting at 60.89, and Brent oil was actually up relative to crude oil, which was down a full percentage point, 64.32. Natural gas, $3.39, which was actually up 1.9 percentage points on the day. Big talking points for oil prices, though. There's a couple things. We did have the U.S. and Iranian delegations wrap up their 5th round of talks, which really, again, I think leads people to believe there's going to be a deal made there, which may or may not include some Iranian exports, depending upon what they decide to do with their nuclear facilities. The big thing that people are watching is that the expectations that OPEC, as they meet this week, they will continue to increase output as a result, looking at about 400,000 barrels per day. However, I do think from that standpoint, Stu, I don't think it's going, it didn't drop prices below that 60. And, as we talked last month, or before Liberation Day, which was tariff day, almost 2 months ago now. I mean, we've really been living in this post-tariff world, as 70 was that new floor. I do think 60 seems to be that new floor unless things continue to go, wonky from that standpoint. I also think, the quote here from Dennis Kistler, Senior Vice President of Trading over at BOK Financial, OPEC will likely agree to further output increases, which, if it occurs, will be a major near-term headwind for crude, especially if Iran adds barrels in the possible U.S. deal. So again, those are the two things that are hanging there. We will see EIA crude oil inventories on Thursday, mainly because of the holiday weekend in there. Finally, though, I want to talk where are oil prices headed in 2025 and beyond. This is a deep dive into Goldman Sachs' bearish outlook, where they have basically rising supply meets rising demand. And as you would say, economics matter. This actually comes from our good friend Ray Trevino, his Substack. And I love this first line, Stu. Oil economics matter at all times, but now it has become the difference between profitability and incurring a loss. Goldman Sachs really doubled down on their bearish oil price forecast through 2026. They're forecasting things at $56 per barrel, and then for WTI, and then $52 by next year. So they're really taking the opposite approach that you did, falling in line more mainly where I have price forecasts. And, as you accurately point out in this article, even, global demand is still showing signs of resilience. These two things seem to be in some weird paradox. You've got demand rising, but then you've got prices falling. And I think it's going to be very interesting. I think what they're really saying is that there's supply overages, where supply is going to be up due to OPEC, the stuff that they're adding back to the market. Also, the fact that you could see Iranian barrels come back to the market. I think they also point to tight inventories, along with the fact that we're going to see some things there. I think there's some geopolitical headwinds that we could incur. I mean, there's always a chance we go to war with Russia. I mean, who knows what happens there. We got to talk about Russia there. But all that means, what does this mean for oil prices? According to Goldman Sachs, they see oil prices at 56, 52. You would probably say that prices are going to be a little bit higher than that. I've said prices are going to be lower. I think the question that really you need to ask yourselves is, assuming the status quo, and this is if you're in the oil and gas investment space, if you're considering investing in oil and gas, the question you have to ask yourself as a chief investment officer, as a hedge fund manager, as a family office portfolio manager, assuming the status quo, $60 oil, we stand today at $60.89. What project works in $60 oil? You have to ask that question. Yes, oil may jump to 100. Yay, then you're going to be able to reap the upside of oil price appreciation.
Right.
The question needs to be what works in this environment. And really, the move from unconventional to conventional seems to be the thread of the needle. And it may even be the move from unconventional horizontal drilling to conventional vertical drilling.
Right.
And I say that, and people might say, well, Exxon's not going to start drilling vertical wells. Well, we're not talking about Exxon. And if you're looking at allocating capital in the energy space and you're just buying stock, well, you're missing out on a huge alpha relative to where the capital profits lie. I mean, when Exxon drills a good well, it's not reported in their stock price.
Right.
So so yes, if you want to invest in stocks, do that. But if you actually want to allocate to the energy businesses and investing in specific businesses, buying equity stakes in them outside of stocks, you have to think what works in this environment and where am I going to be able to see a profitable return? And it's that switch from unconventional horizontal to conventional drilling where it allows you to have much, much lower break-even prices. So that's where that needle needs to be threaded. And then when prices go up, well, guess what? You can then begin to allocate capital back towards unconventional shale, or the vertical wells that you're drilling seem to now appreciate from the fact that you're just now getting that incremental dollar on a per barrel basis. So I think there's a lot of things to thread there, Stu. If you had to make a decision as a CEO on we talked about this a little bit yesterday, but from an LNG standpoint, are you even more bullish on LNG than you are crude oil prices? Because I mean, if you look at this article here, Goldman Sachs has it really low. It's got it different than what you do.
Oh yeah. But you see, Goldman Sachs has got a worse track record than I do. So, you sit back and go, who is paying Goldman Sachs? I want to know who their research is, because you take a look at Josh Young, the head guy over there at Bison Interest. Love Josh Young. And he has said that as the prices stay around the $60 to $65 range, the longer they stay there, they're going to rubber band and go up. You wrote this out, and when you talked about this on the cyclical side of oil and gas, the price goes up. Everybody runs out to the oil field and they drill. The supply side comes up and then everybody shuts back down again. The rubber band effect is going to hit. And Josh Young over there at Bison had a great point. The longer it stays here, the higher up it's going to go. The fact that we still need trillions of dollars to meet normal decline curves has to resonate. And I'm the only one out there saying that. You take a look at demand side economics. India is still high demand. China is still high demand. Those are the two biggest indicators of demand, and they're still on track.
Yeah, no, absolutely. Absolutely. And I think it's just a matter of where and how you want to get in and invest in the oil and gas business. So that's really all I've got though, Stu. We know where you stand on prices. We know where I stand on prices. So with that, guys, we're going to go ahead and let you get out of here, get back to work and finish up your day. We appreciate you guys checking us out here on the Daily Energy News Beat. Stand up for Stuart, Turley, and Michael Tanner. We'll see you tomorrow, folks.